meaningful do you think investment services should be or will be in the future for a bank's bottom line?
Very meaningful. It needs to be meaningful. If it's a rounding error, like we've heard some banks say that we've taken over from some of the bigger publicly traded broker-dealers, they call it a rounding error. Why should I care about this? Well, because it shouldn't be a rounding error. Number one, you're the leader of the institution. That's your job to make sure it's not a rounding error. And you've got to, the first part is partnering with the right institution, the right broker-dealer that's going to help you make sure it's not a rounding error. Some of our institutions right now are, I talked to one of our bank presidents just recently, so it's off the top of my head. About 10% of the bank's net income is directly coming from the investment division. That's meaningful. Yeah. That's not a rounding error.
Right.
That's driving more value for all the stakeholders. And if those customers aren't getting that service locally, what's happening, right? They're not getting it at all, maybe. They're not participating in the capital markets. That's likely not what's happening, though. People our age, you go to a Christmas party, you don't typically talk about where your CDs are, what your CD rate is, right? That's the prior generation or two generations before even, right? Because people our age have our money typically in mutual funds, in their 401k, right? Not in CDs. So banks know that, and credit unions, that they've got to offer this different product line. So you can't believe that if you're not doing it, the customers aren't. If you're not providing investment service, your customers don't need it, and your customers aren't getting it somewhere. So that's not a good answer. The second answer is they're getting it somewhere else, right? They're getting it at a major competitor, and almost all major competitors own a bank, and are selling CDs, and are selling mortgages, and have debit cards. So if they're not doing that, not only, again, back to this, they're missing out, but the 8 chains, the 8 strings versus the 2, eventually, by not making any change, they're working themselves out of business. The ones that want to be here, the ones that want to survive, see what they're missing and see they need to be providing more products and services and the revenue and the retention that comes with those. If they don't, they will be part of the 4,000 that are gone. And that's not terrible. Not everybody's meant to be here forever, right? Their vision may be to sell. Their vision may be to exit the business. That's okay. That's not who we want to work with. We want to work with people that have a bigger vision for themselves. And we're not, those are just the facts, right? If they want a bigger vision for their institution and their stakeholders' future, they need to think about things like this. Ben Bernanke in the Jackson Hole speech, I think in fall of 08 or 09, came out and said, financial institutions need to diversify their revenue sources. They can't just do what they did 100 years ago. The world's changed.